Welcome to the Overberg Asset Management Market Review. In this episode, Nick and Gielie shares with us the highlights of the markets, both globally and in South Africa. If you find this video helpful, please press the like button and don't forget to subscribe to see our upcoming market reviews.
Good day and welcome. I am Nick from the Overberg Greyton office. We are glad that you can join us. Today we are looking at the developments globally, if there have been any changes and how they might influence the markets. So with the meeting, I'm going to start off talking a little bit about some of the investment holdings in the global portfolios. Very positive results to the end of December. So beginning with 3i Group, one of the big holdings in our portfolios, reported total return of 7% in the final quarter of the year, capping a full year NAV return of 32.6% is very, very good. Blackrock World Mining, we have that share in the global growth portfolios. Annual results, NAV up 20.7%. It's benchmarked the EMIX Global Mining Index up by 11, so a huge outperformance. And you'll be pleased to know that Blackrock World Mining has got 21% of its portfolio exposed to pure play copper. Copper is going to be a clear beneficiary from decarbonisation spending, which is a key multi-decade theme for the sector. The share trades on a very nice dividend yield of 5.6%. HG Capital, not to be outdone, final results for the end of December. NAV total return, wait for this, 44%. So that's not a typo, it's 44%. Underpinned by strong revenue and earnings growth from its portfolio. Annualized revenue and earnings growth over the past 5 years, revenue 22%, earnings 28%. Its NAV total return per annum annualized over the past 5 years has been 24.5%. The FTSE All-Share Index, 5.4%. So if you think that's good, let's have a look at the longer term record, which is also impressive. Over the past 10 years, annualized NAV growth of 17.8%. Over the past 20 years, 15.6%. The Euro Area Consumer Confidence Indicator compiled by the EU Commission fell in March by 9.9 points, rivaling its drop in April 2020 at the start of the COVID shock. The war has added fuel to the cost of living through another surge in energy and food costs. In a context of only limited wage growth, real incomes are being squeezed. The war shock has largely offset the tailwind from the lifting of COVID restrictions. The IFO expectations index for Germany has an excellent track record as the lead indicator. Business sentiment in Germany, according to the IFO, has nosedived across sectors, an even larger drop than the one registered at the outset of the COVID crisis. EU governments are struggling to build consensus for any common fiscal response, let alone a strong one. For now, Germany is insisting that EU countries deal with the short to medium term consequences of the war by using their own national budgets. Meanwhile, extending the suspension of EU fiscal rules to next year is far from being a done deal. The risk of a cut-off in the physical supply of Russian gas is still on the table. T.S. Lombard say that the German energy regulator and power companies are preparing for potential energy rationing next winter, which would imply shutting down energy-intensive industrial production and a serious recession for the euro area. Let's look at the Russian economy. So part of it is to do with Russia, but also the impact of Russia's economic crisis and sanctions on the rest of the world. So it's our good friends again from T.S. Lombard. They talk about Russia being under a financial siege, a similar way really to previous wars in past centuries being laid under siege. Well, this time it's a financial siege. Supply shortages, a sudden stop on trade has caused widespread shortages. Foreign value added contributes around 20% of Russia's final demand, and it's even higher in some areas: machinery 75%, pharmaceuticals 57%, electronics 65%, and manufacturing 40%. So if they can't import those products that they add value to, it makes a huge difference for GDP and final output. Then we have a financial and banking crisis. Asset prices have plunged. The central bank has raised interest rates to 20%, and domestic financial institutions face serious stress. Second round effects: plunging demand, tight credit, severe supply shortages will cause many Russian businesses to shut down, triggering significant rise in unemployment and another wave of bankruptcies and economic pain. We have never seen the deployment of financial warfare on this scale. The impact could be orders of magnitude worse than what happened to Iran in the 2010s. So how does this all affect global markets? Well, first of all, cascading losses in commodity markets. So many firms have already sold on in the futures market the commodities they would have imported from Russia and the Ukraine. They've sold those commodities, but they haven't been able to deliver them. So somebody along the line is going to suffer enormous losses. Banks and non-bank exposure. Some European banks have large exposures to Russia and Ukraine. Some asset managers and non-banks are threatened with significant write-downs. PIMCO, for instance, the largest bond investment company in the world, faces a write-down of $3.7 billion. And meanwhile, the reserves of Russian cash are not simply sitting idly in pools of deposits. They were part of complex transaction chains that are now in jeopardy as a result of the international sanctions. Can Russia continue with this war despite the sanctions? Well, that is a huge question, and it all really depends on whether they can find buyers for their oil. Alexander Novak, the deputy prime minister responsible for the energy sector in Russia, has asserted that export volumes could be sustained or even increased with the help of price discounts, which from the present high base would still leave Russia's oil trade highly profitable. Who is buying this oil at discounted prices? Well, the culprits, if you can call them that, are China and India. Those countries hold the main keys to the better case for Russian oil exports this year. How does this all pan out for asset allocation? We start off with MRB. MRB, normally fairly bullish. They say that this geopolitical backdrop is likely to ease reasonably soon, and the global economy, therefore, will sustain solid growth in the year ahead. They observe that the global equity index has recouped all its losses since the war began, although it does remain well below its early January highs. Meanwhile, the third leg of the global economic stool, the first one being America, second one being Europe, third one China, Chinese policy is shifting towards reflation with a stated intention to provide support for the equity markets. With Chinese stocks trading at 2-decade lows versus the global benchmark, the risk reward is increasingly appealing beyond the near term. Capital economics, they've changed their forecasts as a result of the war. They've increased their end 2022 and 2023 forecast for the yield of the 10-year US Treasury bond. They also expect developed market equities to be a bit lower by the end of this year and the end of next year than they previously forecast, although nonetheless still with gains. They also anticipate commodity prices and inflation to be significantly higher over the next 2 years than previously expected. But they expect the hit to global economic growth to be small. Their forecast for the S&P 500 for the end of 2022, 4,600. Previous forecast 4,900. For 2023, 4,800 versus 5,150. They still expect US equities will underperform their counterparts in developed markets as they think technology stocks, which dominate indices of large cap US equities, will be hit harder by rising discount rates and will suffer from a continued normalization in consumption patterns. That's all from my side, Gielie. And then I think also we've had a very good end of quarter or nice finish for the local markets as well.
Hi, Nick. Thank you very much for the excellent macro overview. It's always good to hear the facts rather than the noise from the media. Last week, inflation rate was announced year on year to February. It came in at 5.7 for the CPI, and the core rate was 3.5%. There was no change from the January figures. It was exactly the same as in January. The next day, the interest rates were hiked. The repo rate went up from 4% to 4.25%, and the prime overdraft rate went up to 7.75%. What is important here is that the vote went 3 against 2. There's 5 of the Reserve Bank governors on this committee, and they voted 3 to 2. And the 2 that was against this decision actually wanted a higher hike in the interest rates. They were the 2 hawks, and the other 3 were doves. They didn't want such a high increase in the interest rates. The unemployment rate was announced yesterday. Came in very, very late. It should have been out a month ago, but the unemployment rate for quarter 4 of 2021 came in at 35.3%. That's the highest since this measurement started in 2008. The previous quarter 3, it was 34.9%. These are very disappointing figures. At the moment, 7.9 million people are unemployed. To sum up, the inflation rate is high, interest rates went up, and the unemployment rate went up. It's very disappointing. Then company news, Raubex. The shareholders were advised last week that for the year ended 28 February 2022, Raubex expect the headline earnings per share to be at least 250% higher than the year before. Year on year, the share price went up with 40%. The group is financially strong, the balance sheet is strong, and the cash in the bank is strong. They've got nearly 2 billion rand in cash. And then the foreign net buying and selling of our local equities, it was net buying. Last week it was 26 billion rand. This week it is up to 27.5 billion rand.